they have been performing better than the market, and in good times they have been maximizing it well, and they've been doing it for more than 5 years already. That means that's a very, very good fund manager. That's why it's very, very important not to rush when you're investing into something, because when you take the time to research and when you give yourself the time also to know more about the fund manager, I think it will give you higher level of conviction as well, and it will give you the comfort and the ease that you know that you've invested in a fund manager that aligns with who you are also as an investor. Are you planning to invest in a mutual fund? There's some merit also in investing in mutual funds, because if you're busy and you don't want to nitpick on what stocks you want to buy, what market you want to get into, how you actually want to diversify, investing in mutual funds has its merit. And similar to when I talk about stocks or crypto or NFTs or the real estate market, it's not a one-size-fits-all investments. There would be people that NFTs work for them. There would be people also that crypto works for them. There would be people that stocks work for them. But there also would be people that investing in mutual funds would work for them. That's why I'm making this video for those who are wanting to make it a New Year's resolution to invest this 2023. Here are the 5 things that you need to consider before selecting a mutual fund. For those who don't know what mutual funds is, by the way, mutual funds give you the ability to invest and have exposure to either equities or bonds that have fund managers who will make the decisions on your behalf, that have fund managers who will pick what stocks to buy, and actually what's very, very important, how much to buy, how long to hold on to it, when to get out of that position, and where to transfer it. Do they keep it in cash or do you have to put it into another stock as well? Number 1 is this: before you buy a mutual fund, it's very, very important to know the investing objectives and the strategy. I've said this in different videos. The longer the duration that you have for investing, the longer your timeline, or if you're younger, the more risks that you could actually take as well. You also must consider this: there's a level of risk tolerance that people need to realize, that even if you're young, even if you have a long time horizon, that not a lot of people can stomach a decline. Not a lot of people can sleep well at night if they see their investments go down. You should ask yourself, are you looking for long-term growth, income, or do you want a mix of both? Because please do remember this: what you're buying, if you're buying something that's giving you growth versus something that will give you income, are 2 different strategies altogether. And it's very, very important that all of this must align with your goals and your risk tolerance as well. Number 2 is this: as you start studying the funds that are out there, spend a lot of time to research the fund manager and their investment strategy and their track record. A fund manager with a good track record of consistent performance may be more likely to deliver returns in the future. So please do remember this though: how they performed in the past doesn't mean that's how they're gonna do it also in the future. However, what's very, very important to know, if they've been doing it for a very consistent basis, if they've been doing this regularly, that they have been earning well, that in bad markets, on bad times, they have been performing better than the market, and in good times they have been maximizing it well, and they've been doing it for more than 5 years already, that means that's a very, very good fund manager. That's why it's very, very important not to rush when you're investing into something, because when you take the time to research and when you give yourself the time also to know more about the fund manager, I think it will give you higher level of conviction as well, and it will give you the comfort and the ease that you know that you've invested in a fund manager that aligns with who you are also as an investor. Number 3 is this: fund fees and expenses. Mutual funds come with various fees and expenses such as management fees, administrative fees, and trading costs. These fees can eat into your returns over time, so it's important to consider the total expense ratio, or TER, of a fund before investing. If you want me to talk more about the total expense ratio, I'll try to make a dedicated video on that. Just put it in the comment section below and I'm gonna answer them, and I'm gonna give you a deeper dive on it as well. Number 4 is this: diversification. Consider the diversification of the fund's holdings. A well-diversified fund will invest in a variety of sectors and companies, reducing the risk of loss if one specific sector or company performs poorly. The more they're diversified, the more stretched out they are, the lesser the gains that they could possibly get, because they'll get more than the average. But also, when times are bad, having a well-diversified portfolio will do well for them also, because it reduces their downside as well. So please do remember, a lot of the stocks that funds would normally buy are all disclosed. It's necessary to do your research and check them out as well, so that you would know also what they're currently holding and how diversified they are as well. Number 5 is liquidity. Consider the fund's liquidity, meaning how easily and quickly you can buy and also sell your share. Some funds may have restrictions on buying or selling that could affect your ability to respond to market changes. So please remember, what I like about the capital markets, what I like about paper assets is that as compared to franchising a business, as compared to investing in real estate, is that if you need the money, it's easier for you to be able to sell, and it's easier for you also to be able to convert it into cash as well. Or in the same way also, for example, there's a down market and you think it's really cheap also, it would be easy also for you to be able to come in and buy and convert your fiat, your cash, into shares into the fund. Or in the same way also, if you want to take profits because the market is high already, it's nice to be able to have the flexibility and the liquidity also to be able to start doing that, to be able to get out of your position also as soon as possible. But remember this, that mutual funds are long-term. Mutual funds are not something that you do like how you do it in futures or derivatives trading, that you use 15-minute candles, or if you're a quick trader in the stock market, daily candles as well. It's more for people who are long-term. It's more for people who are busy with other things in life. They're busy as an employee, they're busy as an entrepreneur, that they have other things also that they want to do or need to do as well. Everything else that I've mentioned, mutual funds is just one option for investing. Additionally, it's also important, as what I've mentioned earlier, to remember that past performance does not guarantee future results. And it's important to read the prospectus and understand the fund's risks and strategies for investing. Or you don't have to pit mutual funds versus stocks, or mutual funds versus bonds, or mutual funds versus crypto, or mutual funds versus NFT, or mutual funds versus real estate. Why? Because you can have both. It's what I've been always saying. The name of the game is having assets. The more assets you have, the more items that you could have that will work hard for you. Just for me though, my entry point into the stock market was mutual funds. Before I invested in the stock market, before I entered the crypto market, before I went into real estate, mutual fund gave me an entry point for me to understand the market well. Mutual funds gave me an entry point also that it wasn't so expensive to enter. It was easy to enter, and it was something that I could tolerate. It wasn't something that was risky for me. It wasn't something that the decision to be able to buy and sell was on my hands also. The selection and the allocation, it wasn't something that I had to do on my own. So while I was starting to invest in my early 20s, it was something that made sense for me. It was something that I knew I had to try out. And true enough, over 15 plus years of investing, I don't regret investing in mutual funds. I think it's one of the best things that I've done, especially when I started. I got my feet wet. It made me interested about investing. It allowed me to understand how the markets work. But in the same way, not just me being educated about the markets, it gave me the ability to be able to earn. It gave me the ability to be able to build an asset class that gave me growth and income as well. So please do note, there are different types of mutual funds that have exposure either to the safe ones like money market funds, or you could go to the bond route, or you could also go to the equity route, which gives you a higher ability to earn, but in a way also it gives you a bigger chance also of volatility, and there could be chances also and eras where it could drop and you could also lose a portion of that upside as well. If you want to know more about investing, I have tons of videos about this. Links are down below. If you want to know more about how you can learn investing in the stock market on your own, I've written 5 books about investing. I also have seminars about it that are on demand. You can learn from also at the comforts of your home, wherever you are in the world. And if you've made it this far, and if this is something that's been helping you, appreciate it if you could press the like button. You could put a comment down below and say that you're actually learning from this, and subscribe. So that's it for now. Marvingermo. I hope this video helps you trade well, trade strong, trade smart. See you all again soon, and God bless you.